Risk to reward. Let's talk about that. Most traders are looking for a 2-to-1 risk to reward, which is 50% gain on your money, on your trade. Is that possible? Absolutely, definitely. Is it possible 10 times a day? Most likely not. The probability is pretty low. 3 times a day? Possible. But you're going to have to be able to pinpoint your entries very well. Why do I say 3 times? Your first hour of trading is very volatile with a lot of price action, as is your last hour of trading, called the power hour. And then in the middle, you have a little bit of volume and price movement when everybody's coming back from lunch. Okay, with that idea of a 50% profit on each trade, let's look at some numbers. The rule of thumb when you're trading is to risk only 10% of your account. Now, there's 2 schools of thought here. If I have $1,000 account, then I'm only going to risk $100 per trade, which means I'm either trading penny stocks or options. Not a problem. It's very easy to make that 50% on either one of those. Well, on the options at least. But if you can only get 1 entry a day, 1 trade like that, then that's only 5% on your account. I like working off an account percentage, not necessarily a trade dollar or percent. I want that specific account percentage. So the first rule of thought is 10%. That means I'm only risking $10 or $100 per trade and looking for a $50 profit. Great. But what's my money doing the rest of the time? The rest of that money that's sitting in that account. That means I've got $900 sitting in the account doing nothing if I'm unable to get into any other trades. Not good. I don't like that. So me personally, I tend to, and this is from journaling, every beginner trader should keep a journal. In fact, there are many pro traders who still keep journals. So we can look at where we're, why do you keep a journal? To reflect back. So that's the first rule of thought, 10% of your account per trade. The second rule of thought is, if I use $500 on that trade, I'm not using 50% of my account because I set a stop loss at the $100 mark, which is 10% of the account. And therefore, I'm only risking 10% of my account, but I'm using more funds to go in. And then you're looking for a 50%, which would be a $250 profit on that $500. So you're risking $100, but looking for a $250 profit off that, which would be better. That'd be 25% of your account. Not bad, but unless you absolutely are pinpoint accurate on your entry points, using this method can be risky. It can be more risky than the previous method because, as traders, we tend to be like, oh, it's going to bounce, and it hits your stop loss. If you already have it in, you're stopped out. And then what happens with the next candle when it bounced? Because you weren't pinpoint accurate, especially if you're putting on a dollar amount instead of looking at your support and resistance levels. So until you are really, really good at your entries and exits, don't use the second method. Just go in greater on the first method and jump out. You can always leave runners. What that means is if you get into a trade and you're looking for that 50% profit, personally, I set my goals at 20%. And then I go from there. So, you do you. I don't know what your risk factor is or anything like that. You each have to find your own way, and everybody does it different. But what it means is, let's go with the 50%, 2-to-1 reward. If you hit that 50%, then sell 50% of your holding. So if you're doing options and you're holding 2 options contracts, then you would sell one once it hits 50% and leave the next one running. If it starts to reject or turn around or bounce or whatever it is, if it starts to reverse, that's the word I'm looking for. Oh my gosh. If it starts to reverse, you can get out there. Maybe that's at 60%, 75%, whatever it is, but you're leaving it run. And then you set your stop loss in case it reverses really fast, which we know it can do. It takes a matter of seconds sometimes. You set your stop loss at your 50%, so you continually move that stop loss up. It's called a trailing stop is what it's called, as the price gets higher and higher. Some brokers will allow you to put a trailing stop in. Some will not, especially when you're working with options. It's really hard. So you don't ever put an option in, buy a contract, set your price, your sell or your stop or whatever it is, and walk away. Don't ever do that. If you're in there all day for 9 hours a day, then you're in there for 9 hours a day. I don't think the market's open for 9 hours, but it feels like 15 sometimes if you're in there all day. Then that's what it is. And this is the reason that I do not, I don't trade on days that I have something happening, or I know that something may take my focus away from the trading. This is my money. I'm not going to I want all control. As you can tell, I'm a type A. I have to take all control of my money, every last cent of it. So you have to think how you're going to manage your risk and be smart about it. Working with a small account is what's going to create consistencies. It's also going to show you your weaknesses. If you're not good at your entries or exits, it will show you that. And any strengths. Maybe you are really good. Maybe you can pinpoint those support lines and trend lines very easily. And that's when you say, okay, take profit 1, take profit 2, take profit 3, and you can go in if you're trading options with a higher contract count quantity. I personally trade anywhere from 10. Sometimes I'll go in it with 10 contracts. That's my small. That's my low one. And I'm going up to 100 contracts at a time. So, when I sell 50 contracts, when I reach my goal and then continue to let them run, if I sold half of what's the remainder at each 10% profit point, then that's a really nice profit. But just remember, it can reverse quickly. So be smart about your stop losses and your risk. All right,